Hello, this is Doug Gerlach. Welcome to our Lunchtime Stock Club. Today is Monday, December 12th, 2016. Well, we're closing out the year with an exciting period in the stock market. I hope that your portfolios have been benefiting from the recent rise. We're going to take a look at the state of the market year to date. In today's webinar, we'll also look at a stock of interest covered by one of our iClub Central stock newsletters in the last month. I'll also talk about a book that I've been reading, and we'll have plenty of time to answer your questions as well. Before we begin, let's welcome everyone to our webinar. If you have not participated in our webinars before, if you are having any sorts of technical difficulties, we recommend that you contact GoToWebinar directly. They are our provider of webinar services, and you can find them at gotowebinar.com or via their toll-free number 800-263-6317. If at any point during the presentation you have difficulty hearing me, or if the graphics are coming in a choppy or distorted fashion, we recommend that you turn off any unnecessary programs that are running in the background on your computer, that you don't use Wi-Fi if you have a hardwired internet connection available, and that you can always listen using the telephone, using the phone number and PIN that have been provided in your webinar invitation, and that will free up your computer to deliver the graphics portion of the program. If you have questions, you don't need a microphone. Just type your questions into that questions box in the GoToWebinar application, and I'll be addressing those as we go. I'm monitoring the questions now, and we'll have plenty of time at the end of the presentation. The handout for today's presentation is also available in the GoToWebinar application. Click on the Handouts section there, and you can download that PDF. And there is also a PDF of the stock that we're studying from the Investor Advisory Service, so you can download that as well, save it for future reference, print it out quickly so you can make notes on it, and you can always look for those handouts now at the start of every webinar that we do at iClub Central. Our complete schedule of upcoming webinars is available at iClub.com. Click on the Learning tab to find our schedule and get access to our archived webinars that are available for viewing on demand, as well as links to the handouts. We do have a special webinar upcoming in January, on January 10th, 2017. That's a Tuesday. We're going to be presenting a webinar about My Stock Prospector, where we'll review how to use the program for beginners all the way up to some advanced uses of the tool. We'll take a look at building basic searches using the predefined searches or getting access to some of the more powerful reporting of the program that allow you to customize your watch list and portfolio reports that go beyond simple stock screening. So you'll find that information on the address there, bit.ly/mspwebinar.com. Also send that over in the chat right now that you can, let's see, hopefully everyone will be able to see that, that link in the chat box, or that popped up. You can click on that, and after today's presentation, do the quick registration for that. You'll get an invitation in email as well, so watch the iClub Insider email for more information on that. But that is January 10th, so save that date as well. You can follow along on Facebook. You'll find more information about all of our tools there at iClub Central. Just search for iClub Central, all one word, and you'll get access to our Facebook page for updates there and occasional offers. So I wanted to also talk about and demonstrate one of the new features, new programs that we've launched on the iClub website. It's called the Ultra Bundle, and this is a way for you to consolidate all of your iClub Central subscription-based investing tools to give them a single unified expiration date, so that'll make it easier for you when you're renewing to know which subscriptions are coming due. They'll all be coming due at the same time. And to help you out as well, we allow you to add multiple years and multiple products to your bundle. If you're an existing subscriber, you can try out some new tools. And the way that the bundle works is that the more tools that you add and the more years that you add to the program, the more savings that stack up, and those savings do stack up in a pretty reasonable way. And if you have access to a promotion code, for instance, for the Investor Advisory Service or Small Cap Informer, if you're one of our long-time subscribers, that code will continue to work, so you can discount even more off of that code. This is also a way for us to help secure our subscription base by having our best customers sign up for these long-term subscription tools. In order to get to the bundle, if you flip over to iClub.com and then click on the Products tab or the Store tab. So here we are at the main page. I'm going to click on Products, and then you'll see right at the top, you'll see that iClub Central Ultra Bundle. And I'll just give you a real quick overview of how this tool works. So once you're there, go ahead and create your own Ultra Bundle. I'm going to open that in a new window. And so you'll see some text at the top, and then right here you'll see that there are two options. Either you have an iClub Central login that's used for any of our tools, the Investor Advisory Service, Small Cap Informer, My Stock Prospector, Stock Central, Equity Research Service. If you have a login existing, you can use that even if it's not used for any current subscriptions. You can still use that username and password. If you don't have a login, just go ahead and you can create one, and you will get access to the tool like this. So the way that it works is you can select what tools you're interested in along the way here, and you can see that as we add tools and we add years, the discount grows, and you can select, between 1 and 3 years. You can't add more than 3 years to any subscription, and you can't add less than 1 year is the minimum term. But we will also, if you have existing subscriptions, we will prorate those the term for you, so everything will have one consistent renewal date. And when renewal time comes, you'll be able to simply click once and renew your entire bundle for another 1 to 3 years. And so from there, you can go ahead, add it to the cart. Well, I'll step back here. And we'll show you. In this case, I have Stock Central selected for 1 year. So you see I get a little bit of a savings by going through the bundle. As I add another year, the savings grows. And you can see now 3%, 3.1%. If I go to 3 years, it's 4.8%. As I add another product for 3 years, you can see now the total discount goes up to 21.9%, and that discount will continue to grow as you add products and add years to the bundle. So we think this is a kind of a win-win for customers who are committed to long-term quality and growth-based tools for stock investing. So you can visit it all, find it all at iClub.com and search for or look in the products or the store for the Ultra Bundle program. So that is brand new from iClub.com, and hope that you will take advantage of that next time that any of your subscriptions come due. So as I mentioned, it's been an interesting couple of months in the market, but here's where we stand right now, and this is the 3 market segments that I track. The blue is the S&P 500, the pink or magenta is the EFA, the Europe, Australasia, Far East Index, and the green is the real story. That's the Russell Small Cap Index, which is up 22.2% from the year, recovering even more from the depths in February when the Russell was actually in a bear market, down 20% since the June 2015 highs. So it's recovered more than 20%, 30% from the depths that it was at in February. Those small company stocks have really performed well in the last month. Partly that is due to a sense that small company stocks don't have as much international exposure, and if the incoming presidential administration is focused on pro-American business, that those companies would be likely to prosper. The gain in the index is not really tied to fundamental performance of the companies in the index. At this point, the PE ratio is pretty high. I think it's in the high 50s, when the average for the Russell, the average PE for the Russell is about 39. So this is all based on expectations for the future. While it's good to see, and that's helped boost the small company stocks that you might own, you need to watch on the valuation side, because I think this is pushing the bounds of what we would consider a reasonable valuation. But the S&P 500 is up as well, up 10.5%, 10.6% as of this morning. That's an all-time high. Just like the Dow, the market is reaching new peaks. The Russell at an all-time high, and the EFA is flat at 0% gain year to date. That's still down from the high that was reached in June 2014. So non-U.S. global large cap stocks, as represented by the EFA index, have still not kind of gathered any traction amongst U.S. investors. But that's, again, what we expect is that when U.S. companies are doing well, often the rest of the world is lagging, and vice versa, which is why it can be good to diversify internationally in your portfolio. So here we are with the S&P 500 at a new high of the last couple of years of PE ratio of 26. So that is up from last month, or I'm sorry, in September it was under 25. It was 24.7 when we had our Lunchtime Stock Club webinar, and you can see by the red line there that we have exceeded the highs of all of the markets until we reached the late dot-com 1990s boom, and then PEs went way out of whack into 2008 financial crisis as the PEs jumped very high. But PEs kind of creeping up. And again, 26, now we're really getting into, as an average for the S&P 500, that's a pretty rich valuation, especially as this next slide shows that earnings for the S&P have actually come down. And since the last couple of months, the earnings have fallen for the S&P 500 from 87.35 in September, based on trailing 12-month earnings, to 87.17. So just lost a little bit of traction in the since the September to December period there. Again, the hope was, and the expectation, I think, among many analysts and economists, was that the third and fourth quarter would bring a little bit of recovery in terms of large cap earnings. We knew that they had peaked late last year, and the first couple of quarters of 2016 were going to be a little weak, but that recovery really hasn't hit yet. Even with third quarter companies mostly now reported, you'll see the earnings just really continue to drop just a little bit, flattening out somewhat, but still we're not seeing those gains that would support the run-up of the S&P 500 on a fundamental basis. So that to me is saying that investors are optimistic, looking forward, and expecting good things to come. I think the economy continues to be recovering well. It's not a universal recovery, but there are certainly a lot of great signs that business is good in most of America. Unemployment is at a low below where it was in 2007. So that just means that employment continues to improve, and that's great. Manufacturing, consumer spending is up, and consumers only spend when they are optimistic. They don't spend when they're pessimistic. So consumer spending appears to be good. Corporate spending is down, but margins are up, and that's a sign that companies are retrenching a little bit. And if they're improving their margins, that's going to help over the long term, even if they're spending a little bit less. And we're certainly seeing some companies that are dependent on that corporate spending, and looking at, for instance, the IT services and outsourcing companies. We're just seeing a lot of them struggling with reduced corporate budgets of their clients. Again, in the short term, it's a little bit painful, but in the long term, that tends to support continued growth for those companies. So that's where we stand right now, my perspective on the economy and the market. But of course, we want to continue to invest in quality companies at reasonable prices, and they're going to outperform no matter what happens with the economy and with the market over the long term. So we'll continue to do our best to find reasonably priced companies. In our webinar earlier this month, or I'm sorry, last month, that we held with Dan Boyle from the Investor Advisory Service for the Investor Advisory Service subscribers, Dan talked about the difficulties of finding companies that fit our model that are reasonably priced. It seems like that many investors are fleeing to the kinds of stable growth, mature, well-managed, high-quality businesses that we like to invest in, and that's pushing the valuations of those companies up. So it's a lot harder to find companies that are reasonably priced, that are in our buy zone. But we'll continue to make that effort, and there certainly are companies that you can consider. We'll take a look at one of those later in our webinar here. So let's talk about words of wisdom. I like to always present some food for thought from the greatest minds of the 20th and 21st century when it comes to individual investors in the stock market handling individual companies. And this month, I'd like to talk about the difference of considering products versus considering management, and this comes from George Nicholson from an article he wrote in the 1960s, where he said that one of fundamental teachings of investment education is to rely on management for success, yet reliance on product instead of management is the path of least resistance for novice or mediocre investors and a common pitfall. So he was specifically talking about investors who focus on what a company makes and how much they might like a product, but don't focus so much on the attributes of management. So in other words, falling into trends, being swayed by an interest in a particular product. He wrote in this article, he talked about how Clorox had by the early 1960s had become a household name and was in something like 80% of households were using Clorox as part of their laundry regimen, using Clorox bleach. And a new product had come along, a new series of products, the Better Living Through Chemistry, as you might say, that relied on enzymes to provide the cleaning power, and so a lot of people were afraid that enzyme-based laundry products were going to dethrone Clorox bleach, and so Clorox actually saw its stock sell off. It was part of a mini market correction at the same time that just depressed things further, and as George in the article walked through the importance of looking at the management skill and how management was responding, showed that in fact Clorox was probably a better opportunity, and it really was not as important to focus on this potential threat, but really to look at management's ability in handling it. Later off, he wrote in the article, for investors who are product-oriented, it is important to realize that every product is subject to direct and indirect competition, and that for a period of time sales may slump while the consumer is experimenting elsewhere. That's kind of an interesting, there's a lot in there, as for a lot of food for thought to my way of thinking. I talk in my presentations a lot about considering the direct and indirect competition that may affect a particular company or a particular industry. We get caught up a lot in the disruptors. They get a lot of press, so we hear about, for instance, rideshare, Uber and Lyft, and their impact on transportation, or companies like Airbnb and their threat to the hotel industry. But we have to be able to analyze that threat and see how companies are going to respond to it. Certainly, hotel chains that cater to business travelers are not especially put off by the home apartment sharing Airbnb market. Business travelers just don't have the time or the interest in the savings that come from an Airbnb type situation. So in that case, I would think it would be a mistake for investors to focus on that particular threat, even as indirect as it is. But again, we need to do the analysis. So consider that competition is not the death knell, and the exciting trends and fads that come through and are touted as being the death knell for a particular well-managed company are often not the case. So let's consider management, and let's maintain our focus on management as we move forward. Al says, where do I find this article by Mr. Nicholson? If you look on the Better Investing website and search for George Nicholson and search for 60th, there was part of a series of 60th anniversary articles that Better Investing produced that of reprints of articles from the archives. So search on the Better Investing website in the members area, and you should be able to find it. So what am I reading? Well, as always, lots of books in the queue. I like to read business and personal finance books. And recently I read a book called The Cheapskate Next Door, The Surprising Secrets of Americans Living Happily Below Their Means by Jeff Yeager. Obviously, this is a takeoff on The Millionaire Next Door, but interestingly, there's a lot of habits that correspond between the so-called cheapskate or frugal individual and the millionaire. The millionaire next door. The millionaire next door is not someone who drives the fanciest car and has the most expensive watch, but tends to focus their wealth in other areas and living within their means. Jeff Yeager also wrote a book called The Ultimate Cheapskates Roadmap to True Riches, as well as several other titles. He's spent 24 years working as a CEO and senior executive with national nonprofits in the Washington, D.C. area. He's been on the NBC Today Show and the Planet Green Network, and he blogs at thedailygreen.com. And his website is ultimatecheapskate.com, so you can pick up a copy of it pick up a copy or learn more about it from his website. A cheapskate is someone, and here is the description from the book, of a wife who referred to her husband Frank. Frank's so tight he squeaks when he walks. When he opens up his wallet, Washington and Lincoln squint from the shock of seeing daylight. Cheapskates take pride in many cases in their ability to spend as absolutely little as possible, but it's not only about spending and saving. It's often driven by some other factors. And the book did a survey of self-proclaimed cheapskates and came up with some interesting observations about the so-called cheapskate mind. It found that cheapskates tend to be self-confident and proud of their frugal lifestyle. They don't care about keeping up with the Joneses. They don't care about what others think of them, especially. They really are not interested in buying designer names or keeping up appearances at all. They are proud of their ability to stretch a dollar as far as they can. Social science shows that most shoppers regret about 80% of the discretionary items they buy. Something known as buyer's remorse kicks in so often from people when they make especially high-ticket purchases. But cheapskates are labeled premeditated shoppers, and this helps give them immunity from buyer's remorse. 90% of cheapskates say they never or rarely regret purchases that they make. That's because they're buying carefully, they're looking for things on sale. But one of the things that cheapskates often do is they buy used cars, they buy used computers, they buy used clothing even at thrift stores. So they don't pay for the depreciation. The depreciation, as if you bought, when you buy a new car, as soon as you drive it off the lot, the car is worth less than you paid for it because it is now a used vehicle and not a new vehicle. And that first couple of years, the value drops significantly of those purchases. So cheapskates prefer to buy used goods, so don't have to worry about depreciation. Used goods don't depreciate, they've already been depreciated. And they'll do things like buying antique furniture that retains value or increases in value instead of buying new furniture, which simply becomes used, unless you're going to hold it for 50 years, in which case it might become antique furniture. But again, they may pay more for the antique furniture, but it's going to retain a lot more value than if they had paid the same amount, even for high quality new furniture. Cheapskates believe that stuff tends to disappoint, but experiences add value and meaning to life. So they value the time and the things they can do with that time much more than money and the things they can buy with money. So they're often out exploring the world and taking advantage of the non-materialistic aspects of living the frugal lifestyle. And finally, most cheapskates say it's not really about amassing savings. They're not really looking at building a legacy. But they're often grounded in ideals such as religious beliefs or environmentalism. They believe that it's sinful or amoral in many cases to be a wastrel, to be buying stuff that you don't need or being excessive. And it turns out that cheapskates donate twice as much to charity as the average American. So they're not holding on to their money simply for the sake of holding on to it or building a big fortune. They're actually doing productive things with the money. Couple of the book's basic tips for cheapskates, and again, this aligns a lot with the millionaire next door mindset. But things like don't buy it if you can't afford it, and the corollary, don't run up debt. Cheapskates don't like paying more than they have to, and they don't like going into debt in order to buy something. They believe in reuse, recycle, repurpose as much as possible. Reuse things, and when you can't reuse it, repurpose it. If you can't repurpose it, recycle it. And they believe in, again, getting the value out of every bit of every purchase that they make. Often, always living below your means, living within your means, preferably way below your means. So living in a smaller house than other people who are of your age and making the same amount of money as you do. There's just a big movement in the U.S. to bigger and bigger and bigger houses and bigger lots of land, which require more money to care for. And a lot of people are beginning to see that, we have rooms in our houses that we never use. We have a living room that we never set foot into except at holidays and when we entertain or when we have friends and family over. Otherwise, we're in the family room, which is the relaxing areas. We have a whole room that's not being used. We have extra bedrooms that we don't need. We have big garages and big basements that allow us to accumulate more stuff that we don't really need and we don't have to throw out because we can just put it down in the basement or up in the attic. So living in a smaller home forces you in many cases to make some more interesting or better decisions. They also don't expect that acquiring things will make you happy. They don't believe in retail therapy. Or if they do, their idea of retail therapy is going to a thrift store, getting a like new shirt or outfit for a tenth of the full retail price. Those are the kinds of things that give them a little more pleasure and often usually cost a whole lot less than if they were new. Cheapskates also like eBay and Amazon, where they can get things on sale or at reduced prices. They learn to delay instant gratification. They don't make impulse purchases. They will plan for major and minor purchases so that they're not getting swayed emotionally when they're about to make a purchase. And they teach their kids how to handle money with a similar mindset, teach them the value of money. Instead of buying them the hottest, newest, most impressive new gadget, they will teach their kids that those new status symbols are not always the solution to their individual problems. So I think that's a great book. I wonder how many people, well, the cheapskates are probably not buying it. They're probably borrowing that book from the library, but maybe some would-be cheapskates would be buying that book from Amazon or your local bookstore and learning more about some of those principles, which can help you to kind of realign your own habits to live a more environmentally friendly life, as well as one that provides for more time for you to enjoy with family and friends, and not caught up in the cycle of accumulating more and more and more stuff. Well, so check it out, the Cheapskate Next Door. Now let's take a look at a stock of interest. This month I thought I would talk about a stock from the Investor Advisory Service newsletter. This came from the December issue, which came out at the end of November. The company is Crown Castle International Corp. The ticker symbol is CCI. This is a telecom services company. They operate cell phone towers. We'll tell you more about that business. The current price is $85.50. It was $82 the middle of last month, so it's up a couple of dollars. But the current PE is still only 18, and the yield is 4.4%. The 52-week high price is 103, so it has been a little bit higher in the last 52 weeks, but the buy up to price still well within the buy zone, or right, it's touching up again, bumping up against that buy zone at price at $87. The projected earnings growth is 7%, and you can see if you add the 7 with the yield and with a little PE expansion, you can get that projected total return of 14%. Although a big component of that is going to be that current yield portion of the investment. Here is the graph. The top line is the sales. We can ignore the pre-tax income for the most part. And the bottom is funds from operations. So you see it's, instead of earnings per share, we're looking at funds from operations per share on the bottom. And you can see the high and low prices. So pretty stable, consistent growth. And that $3.6 billion in revenue in the last fiscal year. So the company has been moving along pretty well in its fundamental performance as a mid-sized, what we would consider a mid-sized company. The Crown Castle operates a network of 40,000 wireless towers and 17,000 miles of fiber supporting small cells, exclusively in the U.S. The competitors include American Tower and SBA Communications. Those companies also operate internationally, but Crown Castle does not. So there are pros and cons to that approach, that USA-based approach. It makes it a little easier. You don't have to worry about currency conversion and the uncertain cycles of the economy and the growth outside the U.S. But those companies have a little bit higher potential for growth rate because they're aggressively building towers overseas, whereas Crown Castle is uniquely in the U.S. The idea behind these operators of wireless towers is that the mobile phone carriers don't have to build their own towers. So that's a big capital investment. They would rather not have to build those towers if they can contract with Crown Castle to operate the towers. And so that often allows them to get faster speed to market. If they need to expand in an area, Those carriers don't have to buy the infrastructure. They can simply lease space on one of Crown Castle or its competitors' towers. And that leasing system allows the carriers to focus on their core business, and many of them can co-locate on the same site. So that's incredibly profitable for Crown Castle. If they've got multiple carriers on a single tower site, they've made one big investment to build the tower, and now they're leasing to several different carriers, and so their margins go up quite a bit. The incremental margin from each tenant is close to 100%. It's all profit at that point. These tower firms like Crown Castle generate recurring revenue, and we love recurring revenue because it gives us a sense of how many renewals there are and what those long-term contracts are. So it gives us a high level of confidence in the revenue producing ability of a company like this that has it's all about the recurring revenue. They have non-cancelable long-term contracts, and those include annual rent escalators of 3 to 4%. So those long-term contracts are going to generate an additional 3 to 4% increases on an annual basis. So that is going to again, contribute to the profitability and the revenue growth picture and give us quite a bit of confidence in our growth expectations for this company. Now, as I mentioned, this is a REIT, so that stands for Real Estate Investment Trust. And that's a special category of companies that the IRS recognizes. REITs pay no corporate income taxes as long as they distribute 95% of their income as dividends. Now, of course, investors will have to pay taxes on the dividends, and REITs are not, if you were subject to the non-qualifying dividend rate, REIT dividends are excluded, and that's because there's already been one tax break given to the company. They're not going to extend that. The IRS will not extend that to the individual shareholders. So individuals have to pay taxes on the dividends that you receive, and those would be non-qualifying. Now, when we analyze REITs, we use something called funds from operations, FFO, and we use funds from operations per share in place of earnings per share. Funds from operations is calculated by taking net income, and we add back in depreciation and amortization, and we'll take out gains on property sales typically, because those are one-time items. And we're getting to some other adjustments that are made, for instance, straight-line revenue and expenses, maintenance, capital spending, stock-based compensation, non-recurring items. So often you'll see REITs reporting funds from operations and adjusted funds from operations. The idea behind funds from operations is that when you buy real estate, when you own real estate, every year, according to accounting rules, you have to depreciate the value of that real estate. But in the real world, if you buy valuable property in the right location, property with the right characteristics, the value isn't going to depreciate. It's actually going to go up over time. But the rules, the accounting rules say we're going to depreciate this asset, this property. So that's how earnings per share, when you see them reported, you can actually see companies paying out 110, 120% of their earnings as dividends. The payout ratio is outrageous, and that's because of the non-cash adjustments of depreciation and amortization that have been made to the company's net income that cause earnings to be overstated. So funds from operations allows us to get a handle on the actual cash the company makes from its businesses, again, subject to some adjustments. Now, the problem with FFO is that if you're using Toolkit, you want to replace the earnings per share field with both quarterly and annual with funds from operations. And generally that means you got to dig around. On the company's website, they may report the history of funds from operations, or generally you might have to go to each annual or each quarterly filing and look at the financial statements and find down at the bottom the funds from operations per share figure, and then enter that into Toolkit. That will allow you to see the funds from operations trend on the data. Now, I'll flip over to Toolkit here. So in this case, Toolkit, it says E, that's really funds from operations. If we open up the data window, you can see the tax rate is 0. And again, the company may be taxed on certain operations that don't fall within their REIT framework, but we've taken those out. Generally, I don't look at net profit either, because it's irrelevant unless you're looking at the adjusted net income figure there. But everything in this earnings per share column is this is all funds from operations that have been hand entered into the program. Just by coming to this annual data screen. And we do the same thing with the quarterly data screen, entering the earnings here, going to the quarterly data analysis page to enter historical funds from operations in the earnings as you go through there. Now, when we publish these in the IS or the Small Cap Informer, we make some manual adjustments to the actual labels to reflect earnings per share instead of funds from operations to help clarify. But on the back, the earnings per share and the PE ratios are really PF ratios, right? It's price divided by funds from operations per share, not price divided by earnings per share. So those values are all going to change. And that's okay, because we're looking at what we consider a relative measure. The PE ratio is relative. So by swapping in earnings per share, we're going to find PE ratios that are different from what you might see reported on another website. So again, the best place to go for that information is the company's website directly. You definitely want to check out, go to the company's website. I usually find it easier to go to the company's website as opposed to the SEC and getting the 10Q. If with any luck, you'll find a document that might include the funds from operations history or a multiple year operations report. Some of the REITs that we follow, that I follow for the Small Cap Informer, publish with their earnings report every quarter, also publish a document that has their funds from operations on it, so it makes it a little easier to get at that information. The good news is that we're working at bringing that into the data service for Stock Central and Better Investing, but there's no time frame for that, and it's a long road that we got to work on. But at some point, hopefully, we'll get there. As Jerry says, do club accounting programs handle REITs? And yes, our My iClub and Club Accounting 3 software handle REITs fine. However, the big caveat is that it's going to complicate, REITs are going to complicate things for the treasurer because of the way that the distribution that REITs make each month, or rather each quarter. There are some that make distributions each month, like Realty Income, but a company like Crown Castle that's making quarterly distributions, those distributions may not be all dividend. They might be partially return of capital or some other category of distribution. And at year end, you would have to go back in and modify the quarterly distributions to add additional characteristics of each distribution. So it's a big manual adjustment that you have to make, and that's only because of the requirements of partnership reporting hitting head on with the requirements that companies have to follow when they report at year end on the 1099 how much of each distribution is a dividend, qualifying, non-qualifying, etc. So we don't recommend REITs for investment clubs. However, for individual investors, this is a great way to get into the the real estate market. REITs are a great way to take advantage of some diversification from the real estate sector. And in fact, last month, the S&P 500 index added real estate as one of its top-level sectors. Before that, real estate was the real estate industries were within the financials sector. But now they've been pulled out of the financial sectors and made their own top-level real estate sector, which includes different types of REITs as well as real estate management companies. Company like Crown Castle is not only a real estate company, it's also a telecommunications company. 2 weeks ago, I was giving a workshop in Philadelphia on club portfolio management, and someone asked about, are there any interesting communications companies that fit better investing guidelines? And it's true, it's really hard to find communications companies, even though communications is a top-level sector, that fit the better investing model. But when you look at Crown Castle, this is a company that benefits from the growth of wireless communications, and wireless communications still has a long way to grow, both domestically as well as internationally. When you look at the coverage map for even the major carriers, there's still spots of the country that are just out of zone, and I'm pretty positive you've all experienced this where you get no service. You're not far from home and you're in an area that has no cell phone coverage. Well, that just speaks to the need for continued towers, both the large-scale towers and the small nodes, the antennas that are connected by fiber and placed on the side of buildings or on billboards. Those can provide important coverage in rural areas and small towns and out in the countryside without building giant cell phone towers, which a lot of communities are not especially interested in. So CCI, I think, has a lot going for it. We've covered it before in the Investor Advisory Service, but definitely something you want to take a look at if it can provide some important diversification benefits to your portfolio. So let me see. I think I've hit on everyone's questions there. So and that will wrap up our CCI discussion. We're going to go ahead and just touch base with my schedule over the next first part of 2017 as it stands right now. I wanted to remind you about the My Stock Prospector webinar on January 10th. Better Investing and iClub Central will be back in Orlando at the Money Show February 8th to 11th. In the end of April, I'll be in the Cleveland area, the Better Investing chapter of Northeast Ohio, giving a workshop there for them on club portfolio management. In May, the Better Investing National Conference is also in Ohio on the other end of the state in Cincinnati. In June, I'll be at a joint workshop presented by the AAII and Better Investing in the Washington, D.C. area. So if those areas are on your radar screen or in your area, please take a look there. So we got a couple of minutes. Really quickly, we'll go over a couple of stock ideas that you might have to take a look at. I see Mark asks about TCX. Let me fire up my toolkit here, close out my Crown Castle, and we'll take a look at TCX, Two Cows. This is a company that's tracked by the Investor Advisory Service, and you can see their history has been pretty solid. Things are changing a little bit at Two Cows because they've gotten into the domain registration business as opposed to originally. Two Cows stand for the Ultimate Collection of Windows Software. It was a shareware kind of software distribution business where people could download shareware and freeware programs from the Two Cows website. But they've gotten into some domain registration business, and you can see that's generated some significant uptrends in earnings and profitability going forward. As I said, we've been tracking it. I don't know of any problems that the company's been facing. Our analysts looking at 14% earnings growth, 11% sales growth over the next couple of years. When you look at their margins, you can see the margins have been kind of jumping with this reshift in the business in the last couple of years. So margins are growing nicely there. I think finding a good buy price might be a little trickier, might be a little rich. The current price of 35. I'll do kind of a quick update. This is a down and dirty, non-official IAS update. So, I would see somewhere around 35 being the top of the buy price, and that's where it's at right now. So you can probably just about squeak in on a pretty conservative growth rate and get that 15% return from that company. So yeah, again, this is a little bit of a smaller company at $172 million in sales, but they have been around a very long time, and they've been public for a long time, for a decade as well. So there's some opportunities there to diversify a little bit into an internet content company. It's not always something that we see a whole lot of in our portfolios. All right, real quick. I see Joe says, should a REIT be held in a Roth or a conventional brokerage account? Again, this could be good for a Roth account because of the dividends. There's no problem with holding it in a Roth, but you may choose to put it into to hold your REITs in a non-taxable account so that you don't have to pay taxes on them if you have a choice there, but it wouldn't be a problem. Tracy asks about Stella Jones, and this is a company that's been on our roster of quality. You can see down here it's got a high quality index. This is a Canadian company. It's a lumber and wood production based in the basic materials sector. Trades on the Toronto Stock Exchange, and you can see this is why the roster likes the company. You have to understand that this is a Canadian company, and so all of the income statement items and balance sheet items are going to be in Canadian dollars, and the price is in American dollars, I think, so in the data service, and that's the way our Canadian customers like it. So I think you need to understand the ins and outs of the currency issues. They're not, I mean, you're going to be able to, if you can buy the ADR, that would be one way of going. That's the other ticker symbol, the STLIF, I think, or LJF. As opposed to right on the Toronto Exchange. So I'm just not an expert in them. I tend to stay away from Canadian companies because I think there's plenty of American companies. But again, we have a lot of customers in, across the border from Canada and a lot of Canadian customers, and so that's why we include the Canadian companies in the feed. I don't have any opinion on it one way or the other than this is a pretty consistent SSG, and I know that it's come up on our roster as many times. Okay, so back to Two Cows. Dick says that when you using the start projection from the last quarter doesn't appear to be accurate. So let me just move things around a little bit. So you can see here start projection from the last quarterly data, and you can see where the starting point is right here. So I'll mark it. What's happening here is we've got 1, 2, 3 quarters into the future, but the graph only goes 1, 2, 3, 4, 5 years into the future. So the fact that we're right here at this third quarter in actually The third quarter 5 fiscal years from now would be somewhere out here off the right side of the graph, right? But the way the toolkit graph is built, the way the SSG was designed, we don't extend out. So we actually have this overlap that happens right here. This overlap happens at this point up until the third quarter, where it's actually part of the history and it's part of the future of the company. So if you can imagine that we've got two separate graphs and we've just kind of overlaid them one on top of the other, if we take our starting point, so this is set at the most recent quarter, and if we draw a straight line, you can see that we have just moved this last quarterly dot over to the 2015 line and then started our projection line going out for 5 years. So the data, the numbers are all used based on a 14% annual growth rate starting from the most recent quarter to get to, in this case, $2.93. However, we don't show it starting right here. We move that starting point over to right here. So it's just a restriction of the 5-year history of the graph that since we started adding these quarters to the graph, it's just made it a little more problematic. Without expanding the graph, we just slide over the 5 years, so the starting point is always going to be the most recent year, and then this is 5 full fiscal years later. In this case, it's not the fiscal 2020 that we're looking at, it's the third quarter of fiscal 2020 and the 3 quarters before that. That's the actual end point of the graph there. So hopefully it's a little hard to explain, but hopefully that will make it help you make a little more sense of it. Well, I want to thank you all for showing up today. Please feel free to reach out to me if you do have any additional questions. We'll be archiving this on iClub.com as well as on our YouTube channel. So if you've missed any portion of it or you want to review it, you can find more there. Please, we'll look forward to seeing you next month at our Lunchtime Stock Club webinar. Next week, December, or in 2 weeks from now, will be our investment club webinar, where we'll be talking about closing the books of the investment club. So this is a big year-end webinar, so please let your club treasurers know, especially if they're new. This is a webinar not to be missed, and then we'll be back in January with our next Lunchtime Stock Club and Toolkit 6 user group. Thanks again. Wish you all the best for a happy new year, and we'll see you in 2017.